Here is how we record the journal entries to close our books for the period. There are several different ways that we can do this, but I find the simplest and the most straightforward method to use is called the income summary method. And to use this method, we're going to have to create a brand new account. That account is a transitional account called income summary, and we're going to use it to close our revenues and our expenses. What is a transitional account? Well, it's an account that takes you from one state to another. In this case, our state is having a balance to our revenue and expenses account to the other state, which is having a balance of 0 to close our accounts. So this account only need exist for that purpose. Therefore, this account is also temporary, and we're going to close this transitional and temporary account income summary as well as our revenues and expenses and withdrawals at the end of a period. When we close our books for the period, we always prepare our closing entries in the same exact order. First, we're going to close all of our revenue accounts to this income summary account that we are creating for the purpose of closing. Secondly, we're going to close all our expense accounts to that same income summary account. Thirdly, we're going to close the income summary transitional account to our owner's capital account. And then lastly, the fourth entry is to close our owner's withdrawals account to that owner's capital account. Our company for this example is going to be Anderson Automotive, and let's assume that Anderson Automotive has already prepared their worksheet and their adjusted trial balance and their financials and everything for the period, and they are ready to close. Well, what accounts do they have to close? We know that the temporary accounts are going to be our withdrawal accounts, our revenue accounts, and our expenses. And because Anderson Automotive has good accountants, they prepared the worksheet in the correct order of accounts, which means that all the accounts that are temporary that we have to close are going to be listed from this blue line down. All the accounts that are above it are our permanent accounts. They do not get closed. All the accounts again below it are our temporary or nominal accounts. These are the accounts that we have to reduce the balance of to 0. The first entry we're going to prepare in this closing process is the entry to close revenues to income summary. Well, what is our revenue accounts? We only have one, service revenue. And service revenue had an adjusted trial balance of $21,500. We could go into our T's and look it up and see how we got there. And I'm just making these numbers up for this example, but let's assume that Anderson Automotive Repair had an $11,000 credit to service revenue on the 10th of January, another $8,000 on the 20th of January, and they made a $2,500 credit to service revenue during their adjustments at the end of the month. Well, that's going to bring the balance of service revenue up to that $21,500 that we have displayed on our adjusted trial balance. Revenue accounts are all temporary, which means we don't want to have a balance at the end of the period. We want that balance to be 0. So, what are we going to do? Well, we know this much to be true, that revenue accounts always increase with a credit and decrease with a debit. So we need to decrease this from $21,500 down to 0. How are we going to do that? We are going to debit it for the same exact amount as its balance. Now, if we add all of our credits, $11,000 plus $8,000 plus $2,500, and subtract out our debits, $21,500, we're going to end up with a balance of 0, thus closing our service revenue account. Well, we can't just do this to the T account because we need a journal entry for everything that our business does. So what's the journal entry going to look like when we close our revenues to income summary? Well, we're going to start with the date and denote that it's a closing entry. And just like we did in our T account a second ago, we know we're going to debit service revenue for the full balance of this account, which was $21,500. What other account is going to get used? That is that income summary transitional account. And because we need a debit and a credit and we need to have them equal, we're going to credit income summary for $21,500 as we close January's revenues. In the second entry, we need to close our expenses to income summary. And you can see that Anderson Automotive Repair has the following 5 expenses. They have salaries expense, depreciation expense, interest expense, rent expense, and supplies expense, all with the following balances, which would be contained within the T accounts. These have to be reduced to 0. Well, how are we going to make that happen? Well, we know that expenses are going to increase with a debit and decrease with a credit. So since we have to decrease all of these accounts to 0, we just need to credit it for whatever the balance is for that particular account. So let's get rid of our existing balances and throw a credit in to these entries for whatever their current balance is. And when we do so, it's going to reduce the balance of each one of these accounts down to 0. So essentially what we need to do is we need to credit every one of our expense accounts for an amount equal to that account's balance after we've made our adjustments. The journal entry, therefore, will look as such. We're going to start with a debit to income summary, but we don't know for how much yet, so let's leave that number blank. Next, we can move on to all of our expenses, and we'll credit each one of them for whatever the current balance of that expense account is. And when we get done listing all of our expenses and crediting all of them for the respective amounts, well, our debits have to equal our credits, which means the debit to income summary is going to be equal to the total of all of our credits. So we add up 4,400, 150, 20, 1,200, and 400, and we come up with 6,170. Now our debits equal our credits and the journal entry, and our journal entry is good to go to close January's expenses. We've closed our revenues, we've closed our expenses. We don't need this income summary account anymore, so we can close our income summary account to owner's capital. What's happened so far? What does the T look like to our income summary account? Well, in the first closing entry, we credited income summary for $21,500. In our second closing entry, the one that closed expenses, we debited it for $6,170. So let's throw those two numbers into our T account for income summary. What is the current balance of income summary? Well, we can find it by finding the difference between the two numbers that we put in from our first two journal entries and putting the balance on the side that has the larger number. 21,500 minus 6,170 is going to equal 15,330, and it goes on the credit side because our credit was bigger than our debit in the first two entries. We have a $15,330 credit balance income summary. But this account is temporary. We don't want to have a balance. We have to make that go away. So what do we have to do to make this balance equal to 0? We simply debit it for the same amount of its current balance. And now, when we subtract out the 6,170 and the 15,330 from the 21,500, we're going to have a balance of 0. So we need to make a third closing entry, and it is for the amount that we had to put in to reduce it to 0, 15,330. We're closing it to owner's capital, so we're going to credit our capital account for 15,330. Means that we close income summary in this third closing entry. The reason that I teach the income summary method in financial accounting is it nicely gives you a way to check to make sure that your journal entries make sense. See, we prepare our financials before we close, which means we'll have our income statement done and prepared by the time we're doing our closing entries. Well, for our first three closing entries, we can use that income statement to make sure our numbers line up. In the first entry, we credited income summary for $21,500, and hey, that's equal to our total revenues for the period. In the second entry, we debited income summary for $6,170, and that should always be equal to your total expenses for the period. And then lastly, in the third closing entry, we once again debited income summary for $15,330. And as we see, that is equal to the net income that we're reporting on our income statement. So using this method, that should always be true. The credit to income summary should be equal to your service revenue or total revenues in your first journal entry. The second entry's debit to income summary should be equal to the total expenses on your income statement. And then if you had a profitable month, which we did here, there's going to be a debit to income summary equal to your net income. If for some reason you lost money during the period, well, that third journal entry would be flipped. It would be a debit to Anderson Capital because capital goes down when you lose money, and a credit to income summary. Now that we're through the first three journal entries, we only have the last one left, which is the entry to close withdrawals to owner's capital. Easy enough. We go and we look on our adjusted trial balance, and we see that our Anderson withdrawals account has an adjusted trial balance of $4,000. Therefore, its T, let's say the owner, Mr. Anderson, just took it out once, is going to look a little something like this. How do we reduce it to 0? Withdrawals go up with a debit and down with a credit, which means we're going to have to credit this account for the same amount as its current balance. and doing so will reduce its balance to 0. So the journal entry to close our withdrawal account to owner's capital is going to be a debit to capital. Again, withdrawals decrease the value of the business because you're taking money out of the business for that $4,000, and as we just saw in the T account, it's going to be a credit to your withdrawals account for the same amount, $4,000. And with that, we have closed owner's withdrawals. Just like we checked our first 3 entries to our income statement, we could use our statement of owner's equity to check our 4th entry. Let's start with the T. Anderson Capital would have had a balance at the beginning of the period in its T account, and if there was any owner contribution during the period, that would also be listed in the T account. So let's just assume that Anderson Capital had a balance at the beginning of January of $25,000, and Mr. Anderson contributed $2,000 of his own personal funds to the business on January 20th. Well, in the third closing entry, when we closed income summary, we credited Anderson Capital for another $15,330. So let's add that to the T account. And in our 4th closing entry, we debited Anderson Capital for $4,000. Let's add that to our T account. Well, Anderson Capital, like all equity accounts, is going to increase on the credit side and decrease on the debit side. So if we add our 3 credits together and subtract our $4,000 debit, we are going to come up with $38,330. Let's look over at that statement of owner's equity. What is that $38,330? It is your ending balance of capital, which means that after you get done closing, the balance of your equity, your capital account, your equity account, should always be equal to the same end number you ended up with on your statement of owner's equity.